You pay every bill on time. You don't miss due dates. You set reminders. You feel responsible. And yet, when you check your credit score, it barely moves. Or worse, it drops for no clear reason. After a while, that starts to feel personal. If your credit score feels stuck even though you pay on time, the first thing you need to hear is this: you're not doing it wrong. You're not careless. And you're not failing at credit. In a moment, I'll explain why paying on time by itself often isn't enough, even though that's what most people are told to focus on. Credit scores feel mysterious because they're talked about like a reward system. Do the right things, and your score should go up. Break the rules, and it goes down. But that's not how the system actually works. Your credit score is not a measure of effort. It's a measure of risk. It's designed to answer one question from the lender's perspective. How likely is it that this person will repay borrowed money without problems? Once you understand that, a lot of confusion starts to clear up. Let's start with payment history, because this is where most people put all their energy. Payment history is the largest factor in your credit score. It makes up roughly 1/3 of the total. That's why everyone emphasizes paying on time, and why missing even one payment can hurt more than people expect. A single late payment can stay on your credit report for years. It signals instability even if everything else looks fine. That's why paying on time matters so much. But here's the part most people don't realize. Payment history mostly protects you from damage. It prevents your score from dropping, does not guarantee improvement if other risk factors stay high. This is where frustration sets in. You're doing the responsible thing. You're paying on time. And yet nothing seems to change. In a moment, I'll explain the factor that usually causes this feeling. That factor is credit utilization. Credit utilization is simply how much of your available credit you're using. If you have a total credit limit of $10,000 across all your cards and you're using $8,000, your utilization is 80%. From a risk perspective, that looks high. Even if you've never missed a payment, high utilization tells lenders that you're relying heavily on credit. That dependence matters more than effort. This is why people feel stuck. They're doing what they were told was right, but the system is reading their situation differently. Here's a simple example. Imagine you have one card with a $5,000 limit and the balance sits at $4,000. That's 80% utilization. You pay on time every month. You're responsible. But your score doesn't improve. If you manage to bring that balance down to $3,000, your utilization drops to 60%. That single change can have more impact on your score than months of perfect payment history. This is why progress often feels invisible until something finally shifts. Now add interest to the picture and things slow down even more. Most credit cards today carry interest rates in the 20 to 30% range. Interest quietly works against you, especially when balances are high. Here's another simple example. If you carry a $3,000 balance at a 24% interest rate, you're paying around $700 a year just in interest. That money doesn't reduce your balance. It just keeps you in place. You can be consistent and still feel stuck. That's not a motivation issue. It's how the math works. In a moment, I'll explain why this setup makes people blame themselves when the real issue is structural. Now, think about how most credit card balances start. They rarely begin with reckless spending. They begin with something reasonable: a medical bill, a car repair, groceries during a tight month, a gap between paychecks. Credit cards step in as a buffer. They help you survive when income and expenses don't line up perfectly. In modern American life, that misalignment is common. Full-time work doesn't guarantee margin anymore. Housing costs take a larger share of income. Insurance premiums rise quietly. Healthcare expenses appear unexpectedly. Wages haven't kept pace with all of it. And income barely covers fixed costs. Credit cards absorb the pressure. This is why credit card debt is so widespread, and why it's not about bad choices. But under pressure, people make decisions that feel logical in the moment. They focus entirely on paying on time, assuming that's enough. They move balances around without reducing them. They close cards to feel in control, not realizing that closing accounts can increase utilization in the short term. They chase quick fixes that promise relief. None of these choices mean someone is irresponsible. They're normal reactions to stress. But this is also where people accidentally make things worse. Later, I'll explain what actually helps instead, without hype or shortcuts. Before that, it's important to address the emotional side of this. Credit scores carry shame. They're treated like a judgment of character instead of a risk model. That shame keeps people quiet. It makes them feel isolated, and it makes problem solving harder. If your score feels stuck, it doesn't mean you failed. It means the system is reading signals you weren't taught to understand. Once you see that, the goal shifts. It's no longer about trying harder. It's about working with how the system actually functions. Let's slow this down and connect the pieces. Payment history keeps you safe from damage. Utilization determines whether your score can grow. Interest slows progress. Income determines how much room you have to maneuver. When all four are working against you at the same time, even responsible behavior feels unrewarded. This is why people feel discouraged. In a moment, I'll explain why small changes can still make a difference, even if everything feels tight. First, let's talk about income, because this is where people feel the most stuck. Willpower can't solve a math problem. If expenses are high and income is fixed, there's a limit to what discipline alone can do. At some point, income flexibility matters more than effort. That doesn't mean working nonstop or chasing risky schemes. It means choosing slow, boring, predictable ways to bring in extra money. This is where realistic side income matters. Gig work works because it's flexible and immediate. Freelancing works because skills compound over time. Simple service-based work works because demand stays steady. These options aren't exciting, but they're controllable. Fast money usually backfires because it relies on hype, timing, or luck. Slow money works because it's boring and predictable. You don't need a breakthrough, you need margin. Now let's make this practical. Today, the goal is awareness, not perfection. Look at your balances. Notice which cards have the highest utilization. Avoid adding new balances if possible. That alone reduces pressure. This week, focus on protection. Automate minimum payments so nothing slips. Look for small ways to reduce utilization, even slightly. Even a few $100s can matter. This month, focus on margin. One realistic income move. One boring, predictable step that creates breathing room. That breathing room is what allows progress to start showing up. If your credit score feels stuck, it doesn't mean you're doing everything wrong. It means you were taught an incomplete version of how credit works. Financial repair is slow. It doesn't feel exciting, but it is possible. Once you understand the system, you stop blaming yourself and start making progress that actually sticks. There's more clarity ahead. We'll take it one piece at a time.